Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, who is founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, to start off with the US markets, as we have done for the last few months, US markets are at an all-time high, and I know that you want to show us the chart of the S&P 500 and just to demonstrate how wrong we all have been as a result of the Trump trade.
Yes, that's right. So you're quite right. Everybody sort of thought if Donald Trump won the election, that would be a bad thing for markets, and quite the opposite has happened. And we're now sitting at a situation with the S&P 500, it's up on the screen now, where last night it actually made a fresh new high. It touched the level of 2,000, and I see US futures this afternoon have been trading above 2,200, above 2,200, which is an all-time high for the S&P 500. And what's interesting about this is that this is the first time since 1999 that you've had all three of the major US indices making a new all-time high at the same time on the same day. So that's the S&P 500, the Dow Jones Industrial Index average, and then the NASDAQ as well. So all of those have now made fresh new all-time highs on the same day last night. So that's quite significant. And there you can see since the Trump victory, the US markets have gone crazy to the upside, and it seems like there's still a fair amount of upside momentum in this S&P 500 now. It is getting a bit overbought, but having said that, a strong market can stay overbought for longer than what you might expect.
I suppose in retrospect, one should have gone long the US markets, but if we take it to the South African markets, we're just quite lackluster.
We're very lackluster still. While the US markets are now making fresh all-time highs, we are sitting, nearly 5,000 points below our all-time high on the top 40 index here. So it's still a very weak market, and you can see the technical setup over there illustrated on that chart. There's still a pattern of lower highs and lower lows evident. Our market is trading below the 50-day moving average and below the 200-day moving average. And today it is up, but what we need to see is what happens around about this 50-day moving average. You can see that's the red line that slopes down over there, and it has acted as resistance on the last 3 attempts to break above that. It's actually acted as resistance. So it's going to be interesting to see what happens now. That 50-day moving average comes in at about 44,750. So let's watch that and see what happens. If it were to fail there and reverse down, then there's a chance it goes back and retests that previous low at about 43,000. But on the other hand, if it does start to make higher highs and it begins to push above that 50-day moving average, then maybe we could say that we've got a double bottom in place at 43,000, and maybe we're going to have a bit of upside as we head into the end of the year. So it's a little bit precarious at the moment, but still, as I look at that chart at the moment, it doesn't exactly fill me with excitement, and it won't until it starts to make a pattern of higher lows and higher highs again.
Does it fill you with some degree of consternation because you have an option that exposes you to, I suppose, either side of 45,000?
Yeah.
And so if the market kind of dwindles to 45,000, that's sort of the worst thing that can happen for our portfolio.
Yeah.
And I guess this kind of lack of direction either way must be causing you, if not sleepless nights, but at least give you room to pause.
Yeah, or the counter-argument could be that it's so boring that it's lulling me to sleep every night. Because it's not causing me sleepless nights at all.
Okay.
I'm feeling very confident in the sense that, look at that payoff on this top 40 chart. The diagram on the right-hand side there is the payoff profile of our option structure. And you can see that from 45,500 odd, above that we make money, below that we make money. We make our maximum profit down at 43,000. So if the market were to fall into the December futures close out towards 43,000, that would be a best case scenario as far as this option structure is concerned. As you say, a worst case scenario, and I say worst case in inverted commas, worst case scenario would be that the market just settles around this 45,500 area, and then we would make the minimum amount of profit that we can on the structure as it is. Right now, where we sit at about, I've marked it to market today at 44,800, which is where the market was trading when I prepared these slides. We're sitting with a profit of 9,307 Rand in a mark-to-market profit situation there. So it's not too bad.
Yeah, it's not inconsiderable, but as you say, not the best it could be.
Yeah.
Not the worst it could be either.
No, it's not. So look, I mean, we basically want the market to move from here. We want it to either move higher or lower.
Yeah.
The worst would be if it just hangs around this level into the December futures closeout. That wouldn't be great for us.
Murphy's Law. I'm not going to say it, though. Garth, I know that you want to have a look at some of the individual sectors of the market to tee us up into this week's trade.
Yes.
And you haven't traded recently, but we'll get to that in a moment. But it is in the resources sector, which is clearly the strongest sector on the market.
That's right. So these charts that I'm showing you now are all relative strength charts. So what that means is that we're comparing an index against the all-share index. So this one that I've got up on the screen at the moment is the resources index relative to the all-share index. So just so the viewers understand how we construct this chart is that we take the values, the historical values of the resources index, and we divide those by the corresponding historical values of the all-share index. That gives us a value, and then we plot those values on a graph. And so you can see there's numbers on the right-hand side here, which are quite meaningless, really. What I really am interested in when I plot a graph like this is just to see the shape of the graph. Because when you see a graph that's trending upwards, like this one is, so this is the resources index versus the all-share index, what that is telling you is that your resources index is outperforming the all-share index. And it has been the whole of this year. This chart basically goes back to January of 2016. And you can see that throughout this year, this has been the sector to be in, actually. Which is unusual because for the last 6 years before this, the resources area of the market was an absolute dog, and it was the last place you really wanted to be. And coming into 2016, it felt like, you know, it was all over for the resources sector. And I suppose that they're saying that it's always darkest before the dawn is very true, because it was pretty dark in the resources space in the beginning of this year. And actually that was this time you really needed to be contrarian. And since then you can see the resources sectors outperformed the all-share quite considerably.
And I suspect that's when a lot of people actually got caught in their own kind of negative, their own negativity, and went short the market when it was really sort of awful, and have been scrambling since to catch up, which might have precipitated the rise that we saw earlier this year, sort of between February and March. Yeah,
that's right. There was definitely a lot of unwinding of short resources positions in the first half of this year. But it's since been building on those gains, and you can see technically this relative strength chart is very constructive. You notice it broke out above overhead resistance at the end of September. It's been grinding its way higher, making sort of higher lows and higher highs. That's a bullish looking chart. You can't deny that this is the strongest area of the market at the moment.
Conversely, the weakest area of the market has been what has been the strongest area of the market for the last 6 years, and that's the industrial sector.
That's right. So industrials were the darling of the market since 2009 up until the middle of last year. And this year, it's been probably the worst area of the market from a broader sector perspective. And you can see the underperforming trend there, looking at that industrial index chart relative to the all-share index. And most recently, it's very much the inverse almost of what we saw in the resources chart, where we've actually had a breakdown below relative support over here, and the relative chart of the industrial index versus the all-share index is actually burrowing into new lows for the year to date. So a totally different situation here, showing you that that industrials have really been the weaker area of the market in terms of the broader sectors.
And financials, I suppose that's been fairly neutral, actually.
Yeah, relatively neutral. You can see the relative chart over here, and if you go back to January, you know, that's where the year started, more or less where my mouse cursor is, and you just draw that across, you can see we're at approximately the same level. So on a relative basis, your financial index has done pretty much what the broader all-share index has done. So it's very much a neutral sector as things stand at the moment. So I suppose if you had to put it into order of preference, strongest is resources, then financials, then industrials.
And there is a reason why we've brought up these charts, because you're going long of Kumba, which is in the strongest sector of the market.
Correct. So a simple way to look for your trades is to first look at all the sectors and identify what, if you're wanting to be long, go long in the strongest sector, and then look at the stocks that make up the sector and look for the strongest stocks in the sector. So Kumba Iron Ore is one of those stocks that's been very strong this year. It has outperformed the resources index by quite some margin. And technically it looks pretty good in its own absolute values as well. So here's the chart of Kumba Iron Ore at the moment. This is a daily chart, and we're going to look at an hourly chart in a moment. But what's evident here is this upward trend. Now that uptrend there actually goes back to January of this year. I just haven't gone back as far as that. And then you can see the break above 150 Rand per share earlier this month was a bullish breakout. It takes it to a new high for the year, and actually a new high for the last couple of years, in fact. So it's a bullish break. Now what appears to be happening here at the moment is we have a symmetrical triangle busy forming. And I'm going to zoom into an hourly chart now so that you can see that symmetrical triangle more clearly. Here's the hourly chart now. Now, there's the triangle pattern, as I mentioned. Now, what's always interesting when you get a triangle pattern, typically a textbook triangle pattern has 5 waves, and then you get the breakout on the 5th wave. So what you can see here quite clearly is we've got 1, 2, 3, 4. Now we're in the process of busy beginning to form the 5th wave on this triangle pattern now. So if we start to break out above the upper end of this triangle structure, then that'll be a bullish break, and it should take us back up to the recent highs at about 180 Rand, if not even higher probably. So on that basis, I'm quite happy to go long of Kumba Iron Ore here. I've gone long today actually at 162.50, and I am a little bit, maybe being a little bit presumptuous here, but I'm actually preempting the breakout of the triangle here rather than waiting for that break. And it does add a little bit of risk to the trade, but the thing is, doing it this way also gives me a better risk to reward ratio. So I'm buying it at a sort of an earlier price, if you will. My stop loss is 155 Rand, which is below the lowest point that we saw over the last couple of days. And you can see the red and green blocks there indicate my risk to reward ratio. So the risk is that red block, and that is the difference between where I go long and where my stop loss would throw me out. And then the reward is the difference between where I go long and where my potential target would be. And you can see just from eyeballing that, you can see that the risk to reward ratio, that the reward's about 2.5 times bigger than the risk in this case.
And obviously the reward, theoretically speaking, is higher because of the point at which you're entering the trade.
Yes, that's right. So if I'd waited for a breakout of this triangle, then obviously it would mean that my reward would be smaller and my risk to the stop loss would be bigger. So yeah, it's that old adage, I suppose, greater risk, greater reward, or greater potential reward.
Okay, well, so take us through the trade in greater detail.
All right, so I've gone long at 162.50. My stop loss is 155 Rand. So what that means is that my risk per share is 7.50 Rand per share. I'm risking only 1% of our capital here. We've got 303,000 Rand in the bank at the moment. So 1% of that is 3,030 Rand. So to calculate our position size, how many CFDs we trade, we take the capital risk of 3,030 Rand and we divide that by the risk per share, which is 7.50 Rand. Gives me a number of 404 shares. So I've rounded that down to 400 CFDs. Nice round number. The target is 180 Rand here, and therefore my risk to reward is 1 to 2.3.
And Garth, I mean, we are heading to the end of the year. Futures closeout is in, what, 3 weeks' time, yep. I think. Does it make you a little bit more cautious or maybe keener to enter into trades, before a breakout has occurred, for example, in this case? Because you've also got that consciousness that the time is running out. Yeah,
it does. And we are sort of winding down the clock into the end of the year because we're soon going to wrap up the show for the year and donate whatever profits we've made to charity. I suppose this to me just looks like a decent trade. I don't want to swing too hard, though, because I think we've got a decent profit in the bank. I want to try and protect that as much as we can. And I also know we've got that option structure on, which gives us a bit of comfort in both directions. But I figured a trade like this, if we put a small risk on, who knows, if it works, it adds an extra 2% onto the portfolio for the end of the year, which would be helpful. If it doesn't work and we lose 1% of our capital, it's not the end of the world either.
Okay, so what does the portfolio look like?
It looks like this. We've got 303,000 Rand in the portfolio at the moment, so that's up 21.5% for the year to date. There you can see our option structure still working in the background for us with 5 all-me futures that we long from 45,720. And then Kumba, we are long 400 CFDs from today at 162.50 Rand. So that's how we sit at the moment with a couple of weeks left of the show.
And then you have one last course coming up this weekend.
That's right. I'm down in Cape Town this weekend. That's Saturday, the 26th of November. So anyone that would like to attend this course, please email me, garth@traderscorner.co.za, and I'll send you all the details. That this is my last course for the year.
I have to leave it there, unfortunately. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.